If the mortgage payment barely fits your budget, the house probably does not fit your budget yet. The real question is not just, can I make the loan payment? It is, can I carry the whole house every month after taxes, insurance, utilities, repairs, and the surprises that do not ask for permission? That is the hidden cost of home ownership. This topic is getting attention because many buyers are discovering that the number they saw during shopping was not the number that shaped their life after closing. Recent housing conversations keep circling the same problem. The mortgage is visible, the ownership system around it is easier to underestimate. A useful mental model is this: your mortgage payment is the floor, not the ceiling. Principal and interest may be the biggest line on the page, but they are only one layer. Owning a home means you are also buying responsibility for the land, the structure, the risks, and the services. A loan estimate can be helpful, but it is not your future life in bill form. Some numbers are estimates. Some are missing because they are not lender costs. Some can change after the first year, so a payment that looked neat on paper can feel much uglier in real life. Start with the part everyone understands. Principal pays down the loan. Interest pays the lender. If you have a fixed-rate mortgage, this part is usually predictable. That predictability can make buyers feel safe. But predictable does not mean complete, because the house has other moving parts. Property taxes are one of the first moving parts. They fund local services, and they are usually tied to assessed value and local tax rules. If your home is reassessed, or if local budgets change, the tax bill can rise even when your mortgage rate stays exactly the same. A common shock happens after a purchase. The previous owner may have had an older assessed value, exemptions, or a lower tax basis. After the sale, the county may update the value. The buyer thought the old tax number was normal, but the new bill tells a different story. Many homeowners pay taxes and insurance through escrow. That can make the payment feel bundled and stable. But escrow is just a bucket. If taxes or insurance rise, the lender has to refill that bucket. The result can be a higher monthly payment even with a fixed-rate loan. Homeowners insurance used to feel like a boring add-on for many buyers. Now it is a major affordability issue in many places. Premiums can change because repair costs rise, claims increase, weather risks shift, or insurers decide they want less exposure in a certain area. The mistake is only asking, how much is the premium? The better question is, what does this policy actually cover, and what does it leave out? A cheaper policy with a high deductible or missing coverage can look good monthly, then feel brutal during a claim. If this kind of practical money breakdown helps you make calmer decisions, consider subscribing. The goal here is not to scare anyone away from buying a home. It is to make the full cost visible before it becomes a surprise you have to absorb later. Maintenance is the cost people understand emotionally, but still underfund financially. Renters call the landlord when something breaks. Owners are the landlord. The house is quietly using itself up every month, even when nothing dramatic happens. Paint fades, roofs age, appliances wear down. The hard part is that maintenance does not arrive as a smooth monthly bill. It arrives in lumps. You might have several quiet months, then need a water heater, tree work, plumbing repair, or a roof patch. Averages are useful, but cash flow is what hurts. This creates a dangerous illusion. A month with no repairs can feel like a cheap month. But it may really be a month where the house is building an invisible bill. If you do not set money aside, the future repair becomes credit card debt or a drained emergency fund. A maintenance reserve is not a bonus savings goal. It is part of the housing cost. The exact amount depends on the age, size, location, materials, and condition of the home. A new condo and an older detached house with a big yard are not the same financial animal. Utilities also change when you move from renting to owning. You may pay for more square footage, more exterior lighting, More heating and cooling, water, sewer, trash, and sometimes gas or oil. A house can make everyday comfort more expensive without feeling like a major purchase. More space is not free after closing. Extra bedrooms need heating and cooling. A yard needs water and tools. A driveway may need snow removal or sealing. Even if the mortgage feels similar to rent, the operating cost of a larger property can change the math. If the home has a homeowners association, the monthly fee is another layer. It may cover useful things like shared maintenance, landscaping, amenities, or insurance for common areas. But fees can rise, and special assessments can appear when the association has a large project or underfunded reserves. Some buyers also pay private mortgage insurance when their down payment is below a certain threshold. It protects the lender, not the homeowner. It can be a reasonable trade-off if it helps someone buy sooner, but it should not be confused with home insurance or ignored in the monthly number. The first expensive month is often not the normal month. Closing costs, moving costs, utility deposits, furniture gaps, blinds, tools, small repairs, and immediate fixes can stack up fast. Some are one-time costs, but they matter because they hit right when savings may already be low. Homes often need setup money. Maybe there is no washer. Maybe the old couch does not fit. Maybe the inspection found something that is safe for now but should be handled soon. These are not always emergencies, but they compete with the same cash you need for stability. Imagine a buyer focuses on a mortgage payment that feels manageable. Then taxes, insurance, utilities, maintenance savings, and an HOA fee are added. The exact numbers will vary, but the lesson does not. The decision should be made on the all-in monthly cost, not the cleanest number. The all-in number matters because it changes what the buyer can still do after moving in. Can they save for retirement? Can they handle a car repair? Can they take a vacation without debt? Can they deal with a slow month at work? Housing that crowds out everything else becomes fragile. Being house poor does not always mean someone bought a mansion. It can mean the fixed housing costs leave too little breathing room. The homeowner may have equity on paper, but daily life runs through checking accounts, due dates, and cash flow. Paper wealth does not pay the plumber today. This is why rent versus own comparisons can be misleading. Rent is often the maximum you pay for shelter that month, ignoring your own utilities and renter obligations. A mortgage payment is often the minimum you pay to keep owning. The two numbers may look comparable while the risks are different. Homeownership can still build wealth over time. Paying down principal is real. Long-term appreciation can be real too, though it is not guaranteed in every place or every period. The point is not that owning is bad. The point is that wealth building can be undermined if the monthly load is too tight. Before buying, a simple stress test can help. First, price the payment with realistic taxes and insurance. Second, add a monthly maintenance reserve. Third, ask what happens if one major cost rises next year. If the plan only works when everything stays perfect, it may be too thin. Insurance should be investigated early, not after falling in love with the kitchen. Get quotes before closing. Ask about deductibles, excluded risks, flood or wind requirements, and whether coverage is easy to renew in that area. In some markets, insurance can change affordability more than buyers expect. Property tax research should also go beyond the seller's current bill. Look up local assessment rules. Ask whether the property may be reassessed after sale. Check exemptions carefully. If the current owner has a benefit you will not receive, your future bill may not look like theirs. A home inspection is not just a pass or fail moment. It is a budgeting tool. The question is not only, can I buy this house? It is, what will this house likely ask from me over the next few years? Old systems do not always break immediately, but they age honestly. One of the safest moves is entering homeownership with cash still available after closing. A down payment that empties every account can create risk. The home may be affordable on paper, but fragile in practice. Cash reserves turn surprises from disasters into annoying but manageable events. Listings show the rooms, the yard, the countertop, and the light coming through the windows. They rarely show the annual furnace service, the pest control, the gutter cleaning, the higher electric bill, or the weekend spent fixing something small. Ownership includes beauty and administration at the same time. A better buying question is, would I still want this home at the full monthly cost? Not the optimistic cost, not the first-year cost, not the number that makes the dream work. The full cost, with a cushion, while still living the rest of your financial life. The hidden cost of owning a home is not one secret fee. It is the gap between buying the loan and carrying the property. Taxes, insurance, utilities, maintenance, fees, and repairs turn a house into a living budget category. Seeing that clearly does not ruin the dream. It protects it. If you are thinking about buying, or if a home cost surprised you after closing, share the question in the comments. What part of homeownership feels hardest to estimate before you move in? Your question might become the next breakdown on this channel.